And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
Believe it or not, it's Friday again already, and it's time to welcome to the studio once again from Envision Financial, Luke Smith. Good afternoon.
Good afternoon.
Well, Luke, today we've got the interesting question of the catch-up concessional contribution. What is it and how do you do it? So I've heard of this catch-up concessional contribution, but there are a few rules to keep in mind.
There are, exactly. So we know that you can put $30,000 in every year under the concessional contribution cap. And we know that it's moving to $32,500 with some indexation from the 1st of July. But if we stick with this year's numbers, you can use the concessional contribution cap under a few certain conditions. The first one is that you have total super balance of less than $500,000 at 30 June of the previous financial year. The second thing about this legislation is that allows you to look back a maximum of 5 years. So at the moment it's to 2021 and work out what you haven't used of each of your annual limits in those specific time periods. And what this legislation allows you to do is to look back to 2021 and say, I had 10,000 of space I didn't use in 21, 22, 23, 24, 25. I have $50,000 of cap space that I didn't use for whatever reason at the time. That allows you to make a $50,000 contribution that is tax deductible to superannuation, in addition to the limit that you can work with for the 25-26 financial year. So it's a really, really good piece of legislation that allows people to catch up, as the name says, the space that they haven't used, get a really large deduction if it's appropriate for you in 1 year. You can also use this legislation, again, depending on your balance. Let's say you were at 400,000 and you had plenty of room. You might have $50,000 of space. You might use 30,000 this year, 20,000 next year. So you don't have to use it all in one period, but it is contingent on your broader strategies and how it could benefit you from a tax perspective. Because if we think about its application, let's say I sold an investment property and I've got a large capital gain and my intention was to sell that property to add money to super to bolster my capital balance. I might want to look and say, well, what's my balance this year? It's 420,000. I've sold an investment property. I've got a large capital gain. Wow, a big tax deduction would be wonderful. The catch-up legislation, where applicable, is a great way to get your taxable income down because capital gain on the sale of an investment property is effectively just income tax by another name. So that's a great application of this legislation, in addition to its original design, which was to help mums coming back into the workforce who may have had some time out to care for kids and dads, to then come back, be working full time and be able to bolster superannuation to catch up the time that they lost and get some tax benefit at the same time. So it's really important that you look at this as a broader strategy as part of your super accumulation, but also then to manage tax in the right manner in conjunction with some good tax advice from your accountant.
So what happens, though, if I get such a massive tax deduction that I actually don't have any taxable income at all?
Well, there you go. There's a mistake for young players. So whilst you may be able to do something, it doesn't necessarily mean that it's the right thing to do. And I'll give you an example. If I earn $150,000 and I throw in $50,000 of deductible contribution, my taxable income comes down to $100,000, and the 15% contributions tax that you pay is generally better than your marginal tax rate. However, if I earned $70,000, I don't want to put a $50,000 contribution in. And people say, oh, but you're bringing down your taxable income. But what people seem to miss a lot, it's not the tax bracket that you're in when you receive the money. It's looking at what your effective tax rate would be. And what I mean by that is this. If I'm on $70,000, I'm probably paying about 20% because you're going to get the first 18 for free, then you pay 19 on a bit, and then you go to 32. So if I put $50,000 in and bring my taxable income down to $20,000, I'm actually going to pay no tax, but I'll still pay 15% putting the $50,000 into super. So the super tax contribution is more than your effective personal tax rate. in that example of $70,000, it might be worth putting in 10, 15, 20,000 to get to about $50,000, because at $50,000 to $55,000, your effective tax rate is about 15%, which is equal to the contribution tax rate. Because these strategies are done on the proviso or the assumption that the tax you pay putting it into super is less than the tax you pay on all of your earnings. Now, if there isn't an arbitrage in those two numbers, this sort of thing isn't appropriate. So I see it more often than not, people think they're doing the right thing by adding money to super and claiming a deduction, when in actual fact, they're paying more in contributions tax because they've pushed their income too low. In that scenario, you might want to add to super to bolster your account, then just make a tax-free contribution. Because if your effective tax rate is around 15%, you're not getting any benefit. You can still put money in under the $120,000 tax-free threshold for non-concessional contributions. Great way to bolster super. So don't assume that you have to have a deduction. Look at your effective tax rate, not, oh, I earn this much, I pay this much tax, because you don't. You pay tax all the way up, and you only pay 34 or 39% at the top of that bracket. You don't pay that on all of your earnings. So separate my marginal tax rate at the top of your income from your effective tax rate all the way up the sliding scale.
So always worthwhile keeping in mind what is your tax bracket and what is the overall effective rate of the tax that you're paying.
100%.
So how can people use this catch-up contribution to their advantage?
Yeah, so as we just sort of touched on, mitigating capital gain is a good one. Adding to superannuation where you're in a contracting environment or you've returned to the workforce. I use that analogy of mums coming back into the workforce after looking after kids. You might have had a couple of years off and you're earning $200,000 in your job, and some really big deductions would be advantageous for you, or spreading them out over 2 or 3 years could be great. Again, some good tax advice here is really, really handy. Another way of doing it is that the contracting environment, you might have gone off, done some study, gone back in a contracting environment and got a really high remuneration package, but you didn't earn anything in the last couple of years. So some big deductions in that scenario would be handy as well. So it's really about looking and saying, I want to get my super up, I want to get my tax down, and I want to use the legislation to my advantage, because once you go over 500,000, the doors are shut. And the thing that people need to keep in mind in relation to the application of this legislation that I find gets missed, your eligibility is assessed on the 30th of June the year before. It doesn't matter what your balance is when you make the contribution. So, example, $480,000 in super at 30 June. I put a big chunk of money in on the 1st of December, and on the 1st of December, my super balance has grown to $510,000. You can still make the contribution regardless of your balance when you put it in, because the assessment is 30 June for the eligibility. Find a lot of people look at their balance and go, oh, but I'm 510,000 today, I can't do it. What was it on 30 June? Don't worry about today. So you've got to be prepared leading into the end of the financial year for this, so that you don't misunderstand your availability, because that could prove to be really, really expensive.
If you're approaching the end of the financial year and you're concerned that you might actually go over that $500,000 at the 30th of June, is there anything you can do to prevent that from happening?
Yeah, there are. So if you were over 60 and had less, or you were going to go over 500,000 with growth and contributions from work, you could use a transition to retirement legislation to pull money out, and you could have a 10% payment of your balance to get under 500,000 and then put the money back in the next financial year. Your eligibility would be good there. You could also then look and say, if I'm very, very close, could I super split using the super splitting legislation to a spouse? That could be another way to get the balance down before 30 June, where you super split concessional contributions from the year before. So there are a few different ways that you can sort of play at the edges. If you've met a condition of release and you've already retired, and then you've inherited money or you've sold an asset, you could make a lump sum withdrawal and get that money out of super make the deductible contribution, and then put the money that you took out back in as a non-concessional contribution. So there's definitely some swings and roundabouts that people can consider depending on their relevant situation.
Of course, the one thing that all those ideas have in common is that you need to be planning ahead. You need to be looking ahead and make these decisions before you get to the 30th of June.
It's not a 25th of June. How do we do this? Because we all know that Murphy's Law will apply there, and it won't go your way.
No. So if we've gone past the 30th of June and sadly we hadn't had the foresight to make those arrangements, and we've gone and looked at the balance and checked it and found out, we were just over the 30th, just over the 500,000 on the 30th of June. That's it. It's too late, isn't it? The gate is shut.
The gate is shut. However, it's not shut forever. And what I mean is, if you are in a position where you can bring your balance down, you can be over 1 year and under the next, depending on your situation. And a couple of those examples that I just mentioned could be one. I've taken a transition to retirement pension and I've got my balance back under. Okay, could I now use it? Yes, you could. So it's always an annual assessment of your balance. I had one yesterday where the lady's going to pay off a house. So she's over now, but she's going to quit work, take the money out, pay the house off, consider working in the future. Well, if she comes back and her balance is under 500, she can then look back that relevant 5-year period for the year that she's in and then look to make contributions under the legislation to make it work. So don't fear that you're over once. There are some ways in some limited situations you can get it under.
So plenty to consider, and we're talking about catch-up concessional contributions, the what and the how, and I guess to some degree the why. Luke Smith from Envision Financial is with me today. We'll be back with more in just a moment. Luke Smith from Envision Financial is with me in the studio today, and we're discussing the catch-up concessional contributions, the what, the how, and the why. So, Luke, what are the key things to remember when it comes to catch-up concessional contributions?
Yeah, so as we said before the ad break, the first thing to consider is what's the balance of my super at 30 June? Am I over or under $500,000 from all combined supers? And that would include if you've already taken a defined benefit pension from one of the 4 funds that we have here, because that counts towards your super balance. So don't go, I've got a pension here, but I've got 300,000 in accumulation. It's the total super value of funds and pensions that you've received and have. You can look back a maximum of 5 years for the financial year that you're in. So the best thing to do there, and there's 2 ways that you can generally gather that information. One is to go to MyGov, and if you have your super tied in MyGov, they'll give you a breakdown of what's been reported by your various funds. I wouldn't trust it. I'd then go to your fund or funds, and I'd call up and say, hey, what came in for the 21 year, 22 year, 23 year, 20, whatever's relevant for your situation. They should then match, because there can be a time lag between what's reported in your super fund and when it gets to MyGov. So I wouldn't trust MyGov directly without going to your fund provider for confirmation of the annual amount that's come in. That way then you can take it away from the relevant threshold. Keep in mind that $30,000 has not been the balance of the legislation for the entire period. We've had years where 27,500 was the limit. So don't take everything away from 30,000 because it's the law this year. Make sure you go back and pick the relevant year and the limit at the time. And if the limit was 27,500 and you put 10,000 into super, you've got 17,500 of space for that year. Once you know that number, work out how you're going to apply the cap space that you have. Do I do it all in one go because I have the taxable income to absorb it? If I don't, could I do 2 years this year and 3 years next year? Am I going to sell an asset? Am I going to have a large capital gain next year? Could I hold off super contributions this year, knowing that it'll help save the tax on a investment property, for example, in the year of sale? So that's another way to get the money in. If you are going to make this type of contribution, keep in mind that you must lodge a notice of intent with the fund. And a notice of intent is an ATO regulated form that tells the fund, hey, Mr. Super Fund, I've put in 50, I'm going to claim X amount of that 50. It might be all, it might be half, it depends on what you're doing, but make sure your paperwork is on point. Money in first, form in second, okay? Don't send the form in first because they'll come back and say, Leon, you're not entitled to a deduction because they don't know that you haven't put the money in yet, okay? Don't be that person. So get your paperwork in, get organised, check the balance at 30 June. Don't worry about the balance of your super in that year. If you're eligible at 30 June, you're fine for the 12 months. Reassess it the next 12 months. And if you do go over, think of strategies that may be applicable to your situation, like super splitting, a lump sum withdrawal, transition to retirement, where you could potentially get under the balance to use the legislation again in the next financial year. And it'll be a great way to reward yourself and catch up room that you haven't used because of a change in situation. Because you may have been contracting, you may be a mum coming back to the workforce, you may be a dad coming back to the workforce, you may have a situation where you've gone contracting, all of those sort of examples that we spoke about before the break, where you can make the most of some time off and also bolster your super and lower your tax all at the same time.
You mentioned the notice of intent paperwork there, and of course we didn't touch on that earlier, but that is really one of the most critical elements of the whole process, isn't it?
100%.
What happens if you forget that paperwork?
Then you don't get a deduction. It's treated, so if you don't, let's say you put 50 in and you didn't send in the notice of intent, the fund by default will treat it as a non-concessional contribution, which means there is no deduction provided to you. So it goes in as tax-free money to the fund. You don't pay 15% contributions tax, but the whole point of making a deductible contribution is to deduct that contribution off your income. So you've put $50,000 in super that you may not be able to get for a number of years, and you've had no tax benefit from it. The other thing I will say is that this is just one example. A personal deductible contribution to do this is one example. You could go to your employer and say, hey, I want to salary sacrifice 30 grand of my wages over the next 12 months, and you can use this legislation in the same manner. If you want a salary sacrifice from work, you can do both at the same time. It doesn't matter how you get it in there. If it's salary sacrifice or personal deductible, just get it in there within the thresholds that you have to play with, and you'll be able to maximise your tax position over the full financial year.
So if the money mysteriously, magically appears in your super account and you forget to file the paperwork, the super account doesn't query you about the money?
No, by default, the super fund will treat it as a non-concessional contribution, as the form is titled Notice of Intent. You are notifying the fund of your intention to claim the deduction. They don't know your tax position, so they won't assume it's deductible unless you use that form.
So there's no safety net. Make sure you get it right the first time.
Don't get it wrong.
Indeed. Where can listeners get more information?
So office number 6260-4749. We've got envisionfinancial.com.au on the internet. We've got the podcast, the Strategy Stacker, Luke Talks Money on iTunes and Spotify. We've got the YouTube channel where we have over 400 videos that we've compiled over the years. And you're in the majority of them.
I know.
It's Envision Financial Canberra on YouTube. And we've got Smart Money Strategy, your ultimate guide to financial planning in all good bookstores and online. And there's an entire chapter on deductible contributions.
Fantastic. Luke, have a terrific week. We'll catch you again next Friday.
See you next week.
Luke Smith from Envision Financial back with us in the studio at the same time next Friday afternoon right here on 2CC.